This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of the DeFi Decoded podcast. I'm Alex Tapscott here with co-host Andrew Young. Andrew, so just when you think it can't get any worse, we get more news out of this FTX saga that potentially means it can get worse, and there are other dominoes to fall. The most recent is the digital currency group, and specifically a subsidiary of that business called the Genesis Trading. Genesis is the largest crypto asset lender. I think at one point they'd underwritten over $50 billion of loans, mostly to hedge funds and other institutional investors, and some of those loans obviously have gone sour, and that company is in trouble. It is appealing, I think, to its parent company DCG for funds, but it looks like, at least at this point, it's actually out in the market right now raising capital. A digital currency group is not like FTX, something that's kind of come out of nowhere in the last couple of years. DCG, started by Barry Silbert, is probably one of the longest standing firms that's in this industry, probably along with Coinbase and Kraken and some of these other ones. Barry Silbert was the founder of Second Market, which was the largest platform for trading private shares in the US, like Facebook, before it went public. And he applied that sort of thinking towards another alternative asset class, crypto assets, and has really built a real empire, right? In addition to Genesis, there's Grayscale, which is the manager for several OTC listed Bitcoin and other crypto asset trusts. And he's got investments and really assets and influence in dozens of different projects and many different companies as well. So this is sort of like the heart of the business, in my view. And maybe that's a problem, that there is a heart of the business for something that's supposed to be decentralized. But either way, this is a technology, or excuse me, this is a player that's obviously kind of systemic as well to the industry. So can you fill us in a little bit? What's your take on what's going on with Genesis? Does it impact DCG, and what could this mean for the whole industry?
Yeah, this has been a pretty shocking sort of turn of events, particularly because Genesis initially put out a statement saying that they had no exposure to FTX. I mean, at this point, it's become a meme for people to say they have no exposure to FTX. And then the next day announce that they're halting withdrawals, and then the next day announcing that they're bankrupt. But a lot of people didn't think Genesis would have been a victim for this, particularly because digital asset group, or digital currency group, I should say, has such a large sort of balance sheet, or was at least seen to have such a large balance sheet of varying assets that they could use to sort of plug the hole, if there was any hole. But as of now, essentially what happened is Genesis Capital, which I believe is the lending arm of Genesis Markets, which does a variety of things, such as they're one of the largest OTC desks for Bitcoin, so you can buy and sell large chunks of Bitcoin through Genesis. But anyways, Genesis Capital, which is the lending arm, made a series of risky, unsecured and secured loans to various crypto hedge funds. The big ones being Three Arrows and Alameda, which is obviously the sort of sister hedge fund of FTX itself. So I guess while it was true that they didn't have exposure to FTX directly, they effectively did through Alameda. And like you said, these loans have essentially have to be written down. And right now, the estimated hole is somewhere between $1 to $2 billion. There's still kind of people don't necessarily know how big the hole is yet. But Genesis has been trying to raise $1 billion over the last week to sort of fill this hole. And from what I can tell from reading on Twitter and things like that, there's almost no appetite for this deal. And actually yesterday they slashed the target from $1 billion to 500 million. Yeah. And then there's now been rumors that a bankruptcy announcement is coming any day now. Interestingly enough, actually, Barry Silbert, just before we hopped on this call, he actually just scrubbed his Twitter of any mention to DCG Group or Genesis or anything like that, which is also typically a very bad sign. I mean, we've seen sort of SBF do that as well right before resigning, and so it sort of lends credence to this idea that a bankruptcy of Genesis is coming very shortly. And yeah, I mean, it's just another huge sort of domino to fall in digital currency group. And I think the biggest thing that it's one thing for Genesis to fall. It's another thing for the parent co to fall because of the Grayscale Bitcoin product. And that's something that a lot of people have been trying to figure out, sort of what does that mean for the Grayscale Bitcoin Trust? I'm actually curious. I mean, you guys have a ton of experience running a public Bitcoin trust. What's your take on what happens with Grayscale in a potential liquidation of the parent co?
It's a really interesting question. So I think people should understand that based on everything that's been reported, Grayscale's the assets of the trust holders are separated from the balance sheet of the company, right? So they're not commingled in the way the FTX's assets might have been. That's what's being reported, and that's what Coinbase and others are corroborating. So at this point, I've got no reason to doubt that. The bigger issue is around the nature of this trust and how it trades. So the Grayscale Bitcoin Trust, for the longest time, was really the only way for a mainstream investor who didn't want to own the underlying asset to actually gain price exposure to Bitcoin, to Ether, and to other crypto assets. And so because of that sort of scarcity value, I guess, it traded at a big premium to NAV for the longest time. And actually, there was a very popular trade that a lot of hedge funds engaged in, which is that they would basically create units and then short Bitcoin, and then the future dates sell it at a premium, right? And sort of capture like a 30% risk-free return, which is something that worked super duper great so long as there was a premium in place. What ended up happening towards the end of 2020 and into early 2021 was that premium started to go away. And with the announcement of the big Bitcoin trusts in Canada, including the 9-Point Bitcoin Trust, but especially the announcement of the Purpose Bitcoin ETF, all of a sudden the premiums on those trusts went into pretty severe discount, right? And started trading below NAV, which is actually typical for a trust product. There's sort of like a holdco discount, so to speak, for a lot of these kinds of funds and other kinds of assets, like say commodities like gold, for example. But what a lot of those funds have is a feature that allows you at some future date to redeem your units for whatever the underlying net asset value is. So, if you've got, and that is a way for a lot of these trusts to keep the discount relatively tight, right? So if the discount goes to 5%, an arbitrager will come in, they will buy the trust units because they're basically buying the asset at 95 cents on the dollar. They will hedge their exposure to the underlying asset, and then they will clip this 5%, and then they can lever up and sort of increase their returns. Except the problem is that the Grayscale Trust product does not have a redemption feature at all. Now, Grayscale has said, and what that means in effect is that, it's like Hotel California. You can check out anytime you like, you can sell this thing, but you can never really leave. Like, you're going to be trapped into this situation where you're taking a massive haircut if you happen to have bought it earlier on at a price that's closer to the net asset value. Now, Barry and DCG have said that the moment that the SEC allows for an ETF, they're going to convert this thing into an ETF. And when they do that, what's going to happen is that discount is going to go pretty much to zero, right? It'll be basically trading close to NAV. There'll be a time value of sort of the money between when they announce it and when it actually converts. But once it's converted, it'll trade plus or minus a few basis points relative to NAV. And the reason for that is that ETFs have daily creation redemption features. So anytime it gets too far away from NAV, an arbitrager will come in and make a risk-free trade in a day. And so it keeps it extremely tight to the NAV. Like, I'm talking like plus or minus 20, maybe 50 basis points. So like less than 0.5%, not 50%, less than 0.5%. But what we're seeing recently is that this discount is actually continuing to decline even further. And I'm only speculating, but one sort of theory that I think is kind of interesting is that if Grayscale if DCG needs to basically raise funds to save itself, one of the things that is very valuable is the management contract on the Grayscale funds. So it's still, they're getting paid 2% on NAV, not on the value of the units, which are at 50% discount, but on the actual net asset value, which I think today is still like, over $6 or $7 billion, right? So that is a huge cash flow stream that someone would love to own. But anybody who buys that is not going to open up a redemption window, allowing people to redeem their units, because the second that they do that, their NAV is going to go basically to zero, right? Like, why wouldn't this is a highly liquid product? Hedge funds and arbitrageurs would flood the market, scoop up units at a discount, and pound that redemption window and basically arb it down to zero. So I think that, like, the fact that the spread is blowing out even more suggests to me that maybe that the market is pricing a sale of Grayscale, or liquidation, like a sale of the actual business unit, to another manager, and therefore basically locking in this lack of redemption window in perpetuity. I don't know if that's the case. Like, it's just a theory, but a lot of people are talking about, the units are crashing, like the values declining because, of worries about the custody of the assets and are they there? And that might be a concern. Like, I don't have any evidence to suggest that, but I think like a more logical thing is, like, in the moment we're pricing in the fact that there's never going to be a redemption window for this product and people are going to be trapped here forever. And so why shouldn't it keep trading and drifting lower and lower, discount to net asset value, right? These are captive assets. So that's my view on what's going on, but I know others have different opinions.
And so what does that mean for the market? Like, I'm not as familiar on sort of the dynamics of what happens if Grayscale is sold versus if it's liquidated. I know, like, one of the big fears obviously was if it is liquidated, that would be about 600,000 BTC hitting the market on the spot market, which would just be devastating at this point. But I'm curious, what are sort of the implications of DCG itself being sold? And what does that mean for, I guess, like spot Bitcoin prices and things like that?
Well, I don't know about DCG getting sold, but I think, like, if they needed to raise money, like, what's the management, what's owning the GP, like the general partner on Grayscale, worth to someone? Well, if it creates like $100 million of revenue every single year, and, like, there's a 50% EBITDA margin, and it's probably way higher than that because the cost to manage and administer these things is pretty limited, like, frankly. You're looking at an asset that could be worth like a couple $2 billion. I don't know. I'm just making these numbers up. So, like, it's not investment advice. Don't hold me to any of this. I'm just saying it's an asset that's clearly worth a lot of money, but it's only worth something if people can maintain the status quo of whatever the fund terms are, right? To make sure that, everyone's still subject to the same terms and can't redeem at any point in time. I don't really know what the liquidation scenario is, other than, I really can't think of it. You can make the case that maybe in order to make investors whole and to restore confidence in the marketplace, and in the asset class, they open a redemption window, and then these things trade all the way up to NAV, and that's a multi-billion-dollar windfall basically for unit holders, right? Like, if you have a unit that's worth $1, it'll be worth $1.95, right? It'll still trade at a slight discount, but it'll be worth like almost double what it is. And that all of a sudden, I think, could just improve the sentiment out there. But if that happens, that means there's going to be a moment when they actually have to redeem and sell it, and then that'll create selling pressure. So I don't know. It's a bit of a double-edged sword in that respect. So I can't really predict it. But at least right now, the leading theory that, maybe the asset's up for sale at some point in the future seems plausible, but I don't really know. Like, I think we're all kind of guessing here.
Yeah. And I think just further to your point, Coinbase actually came out yesterday and said that all the assets are fully held. All the assets for the Grayscale are fully there. There's no sort of there's no counterparty risk, or at least they tried to tamp down the temperature on there being like potentially like an exploit or something like that. Like at least according to them, the assets are fully reserved. It is interesting because this trade, there's been a very common trade, and it's been kind of categorized as a widowmaker trade within crypto, of buying the GBTC product and then hedging by shorting spot. And it's so and just kind of banking on the divergence between the two fading over time, or at least getting closer.
Yeah.
And it's just interesting that it just keeps getting wider. Like it's also interesting because you would think that that would put a lot of pressure on the SEC to allow redemptions, which would obviously close the gap and make that type of trade incredibly profitable. But
well, so there's a couple things there. So Grayscale at any point in time can change its terms to create a redemption window. You don't have to be an ETF to have a redemption window. Lots of trusts have them. This one just doesn't happen to have one. But it's true that Grayscale has said that the second an ETF is allowed, like by law or whatever, by the SEC, that they will do it. That's what I'm saying. That's why I think the ETF thing is interesting. Yeah, I mean, I think that there's a lot that regulators could be doing more of in the US. This was one example of that. If they approved Bitcoin ETFs, I think that would be, frankly, like a salve to the industry at this particular moment, because it would, address this issue and potentially others as well.
Yeah, for sure. And one of the firms that's been sort of asked to potentially step in on Genesis is a company called Apollo, which I believe is also launching a tokenized fund. Is that something you've been sort of following on the tokenization front? Because I know that's something that you've been sort of advocating for and monitoring.
Yeah, absolutely. Well, I mean, Apollo is a private equity firm. If the opportunity gets attractive enough with DCG, they might make a bid. But I think the other thing you mentioned, which is that Apollo and also Hamilton Lane, another large asset manager with about 800 billion of assets, those two together, I think, are like almost 1.5 trillion, have both announced that they are going to be basically like launching fund units on chain as tokens using this service Provenance, which is something that's been created by this company Figure. Provenance, I guess, is just a blockchain. And it's just a reminder that amidst all this carnage, there seems to still be enterprise and financial adoption of Web3 and blockchain tooling. And I think that's interesting. And it's different from our institutions buying into the asset class. We may have talked about this before, but there's an obsession with, how many institutions are buying, MicroStrategy shares or buying into Bitcoin or what have you, or buying Grayscale's fund, and not enough about how are big enterprises and financial institutions integrating this kind of tooling and this kind of technology into their underlying business. There are definitely like obvious advantages and some interesting benefits to doing this kind of thing. Securities mostly trade sort of T+2, T+3. There's like a lot of business logic that happens behind the scenes involving many intermediaries. So having transactions that are atomic, basically clear and settle instantaneously between counterparties, I think is something that's really interesting to financial services firms. All sort of accounting and transactional data can be reported on chain, including share registries, voting records for proxies, and other sort of material trading information, and that would reduce back office expense and just the complexity of operating markets and sort of improve and streamline market structure. And then the final thing is that potentially, and this is something that's more regulatory constraint, anybody with an internet connection could invest into assets that can create real wealth. And it's not to say that crypto assets are not going to create real wealth, but there's a lot out there beyond, user-owned networks and cryptocurrencies. There's companies and property and other really valuable kinds of asset classes in the economy, and creating ways that make it easier for a broader swath of investors to get access to that, I think, is a good thing. Incidentally, like Apollo and KKR actually, which is another big private equity firm, they also announced recently that they were planning on tokenizing units of their funds. These are funds that are typically reserved for institutional investors or ultra high net worth. And so part of this is also to kind of lower the barrier and democratize access to their fund products. Now, I haven't looked at the fine print. It's possible they're still available only for accredited investors only. In the end, these are still private equity funds. They're not, public equities. And so by law, certain people might be exempt from being able to buy them. But overall, this is the kind of thing that can help sort of improve access to financial products and to financial services. And to me, this is a theme that's going to be very prevalent in 2023. A couple of weeks ago, you spoke at the event we hosted, W3B in Toronto, and the big theme was about enterprise adoption of Web3, and not them building out little closed siloed systems, but embracing and adopting tokens and public blockchains. And I think that's going to be one of the few tailwinds actually for the asset class and for the industry for the next year or so. Certainly a lot of the trading and speculation is going to calm down in light of the contraction of credit and debt and leverage in the market. And so we need to see this kind of real world applications to continue to pick up steam in order for the asset class to also do well. Because in the end, if someone's building a tokenization project leveraging, say, the Ethereum blockchain, they may actually need to own the underlying asset in order to run a node or to act as a validator or to pay for gas or whatever on the network. And that means buying demand for the actual asset class too. So these two things are inextricably linked as well. And so it's something that I think is really important. And we shouldn't lose sight of that with all of this cacophony of chaos that's happening around us.
Yeah, for sure. And I think just on your point of increasing sort of the amount of on-ramps to crypto. I mean, it's shocking. When I first got into crypto, the on-ramps into crypto were not very good. And for the most part, we actually, like, I've used Genesis, funny enough, as like one of my main sort of on-ramps, as well as Coinbase, though it is quite expensive. And one of the things that's kind of most shocking to me is how 5 years later, the on-ramps are still quite high friction, to be honest with you, at least for products beyond Bitcoin. So for Bitcoin, obviously, you have things like the 9-point Bitcoin fund. You have things like Grayscale, for example. Like, there's a lot of ways to pretty easily access Bitcoin exposure. But for pretty much anything outside of the top two, I mean, there's obviously a couple of Ethereum products as well. The sort of friction it takes to actually get exposure to crypto is still incredibly high. And so I think things like tokenizing funds and just making them easier to access, and also just making them more useful by having them on chain, will do a lot to really further the ecosystem, given, again, how incredibly hard it is to just access anything beyond Bitcoin or Ethereum. And that's why you still see, obviously, VCs and hedge funds within the space are still sort of the main capital allocators. Whereas if you look at sort of traditional equities, obviously ETFs and things like that, and mutual funds make up sort of the majority of capital allocation. And so, yeah, I think things like the tokenized fund, and honestly, the stuff that you guys are doing with 9-point is hugely important to the crypto ecosystem.
Yeah, well, thanks. I appreciate that. And in the end, we think it's interesting. We think it's important, obviously, that people understand about self-custody, and that the fact that you can sort of own your own assets and take them with you is one of the big benefits of this. But there are also lots of investors who want price exposure to a new technology or to, a new industry. And investing via regulated markets like the 9-point Bitcoin ETF is a good way to do that, right? For those kinds of people. It's the centralized exchanges. Someone actually in the industry said they're sort of the worst of both worlds, right? They combine the risk associated with a centralized intermediary with some of the security concerns around the asset class itself, and into a kind of combination that is the worst. And he actually said, we're better off just sort of going full decentralized, or going back to the old banking world, but because having crypto banks is sort of a funny combination. And I think that there's a lot in that comment that reveals how just skeptical and cynical everyone is at this particular moment in time. But there are things that can be done to make centralized exchanges operate better. Maybe, as in the words of one person, they should be like public bathrooms. You go and you do your business and you leave. If you spend too much time in a public bathroom, bad things are going to happen. Maybe that's how we should be treating exchanges. I hope that's not the case. I think that there's probably a role for trusted third parties to act mostly as custodians for assets in this space, but we need to come up with some standards that make them safer. So some of those standards are what you'd call so-called fiat solutions, basically old world solutions, things like regular audits, having greater regulatory oversight, or improving corporate governance. I think we can all agree those are probably good things for any corporation that is holding billions of dollars on behalf of customers, especially retail customers, that they should be subject to that kind of treatment. But there's also this idea of on-chain solutions, practicing safe sex, as they say, right? A CEX, things like proof of reserves or proof of solvency. And this is something that Vitalik actually was talking about a lot on his blog recently. And I'm wondering if you just have any thoughts on that, and if this is kind of a too good to be true, or if there's a potential solution to using on-chain data to help provide comfort and confidence to users about the solvency and the, the sort of good standing of companies in the space.
Yeah, it's really interesting. I mean, so yeah, like you said, Vitalik wrote something about this. I'm not as kind of like as Vitalik does, he wrote sort of a fairly technical article on how it would work using sort of a Merkle tree technique. Don't need to go too much into it, but essentially, yeah, it's essentially, it allows you to prove that customers' deposits equal the amount of coins that you hold without actually disclosing how much there is. So it's kind of like you can show that proof of liability. You can show proof of liabilities and proof of assets, which he terms as sort of proof of solvency, and without sort of leaking too much privacy. So I think it's a very interesting thing. I mean, I just don't know. I mean, I think there's going to be a huge push towards stuff like this, but it's really tough because not all, from what I understand, like not all liabilities for a lot of these exchanges can be sort of proven on chain.
Yeah.
And so I think like right now, what centralized exchanges are doing are essentially just one half, which is the proof of assets half, but it's kind of useless in a way if you don't see the amount of liabilities that are sort of stacked up against that. In the case of FTX, though, I should say sort of on-chain sleuths were able to show that FTX had sort of less than $1 billion or less than $1.5 billion of assets, which sort of pretty clearly showed that they were insolvent unless they had some sort of secret cold storage wallets that no one had been able to find. So
Yeah.
for things that are sort of, I guess, what we would term incredibly insolvent, like FTX, proof of assets helps a lot because you can kind of eyeball it and see that it doesn't really make sense. But for other exchanges, particularly given how many exchanges in the space sort of wash volume and sort of fake their stats, it's really difficult to know, even ballpark their sort of liabilities. And so just showing the proof of assets, which is kind of what most of the centralized exchanges are doing right now, it doesn't really give you that much information. And so what's interesting though, my thoughts on proof of solvency, to be honest with you, is that the easiest way to show proof of solvency is for something like Osmosis, which itself is an app chain, because it's all fully transparent and you can see all the assets in the bridge in real time, second by second. So the interesting thing to me is I don't think proof of solvency is going to be what makes everyone trust centralized exchanges more. I think centralized exchanges becoming effectively their own chain, which is kind of what Osmosis is doing through their decentralized exchange app chain on Cosmos.
Yeah.
That is kind of, to me, the more obvious long-term solution. I think DEXs adding fiat on-ramps so you can buy crypto with your bank account, things like that, which may require DEXs to sort of converge with centralized exchanges in the sense that they may need to have at least some form of KYC and AML.
Mm-hmm.
I'm not really sure what the future looks like, but I just think that is a much more obvious and just clearly better future for the ecosystem as a whole, versus trying to make centralized exchanges more DeFi. Let's make DeFi or DEXs a little bit more CeFi, and maybe not CeFi, but just easier to use.
Yeah, easier to use. To me, it's like it's an interesting tool to prove reserves, but you can't prove the non-existence of a liability, as Mike Belshie said on the last episode of DeFi Decoded, right? So you can kind of only see like one side of the ledger, so to speak. when using proof of reserves. And I think you're probably right that in the end, it reiterates just once again, if everything is on chain, and specifically on its own app chain, like Osmosis, then you're going to get a higher degree of transparency. As someone who uses Osmosis personally, I actually think it's incredibly easy to use, and is maybe a model for others, but that's just my opinion. But if people want to check that out, they probably should. Anyway, okay, that's a bit of a diversion. It's a great discussion today, Andrew. We covered a lot of grounds here. The DCG question is ongoing. Maybe by the time people listen to this, we will have an answer on these matters. I do think that the news out of Apollo and Hamilton is clearly a big deal for the ongoing digitization of assets, which I think is a multi-year trend. It's worth pointing out, by the way, that public equities, for example, in the US alone are worth $40 trillion. So these are markets that completely eclipse what's been digitized so far just in the crypto space. And then obviously this idea of on-chain reserves, I think any tool can help. I think we probably need all the fiat and on-chain tooling that we need to restore confidence in the industry. Let's leave it at that. Great chat as per usual. We will see everybody next week. Make sure to like, subscribe, comment on YouTube, wherever you get your podcasts. We appreciate the feedback, and we will see you next week. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.